Welcome back to the show. It feels like every time we open the news or scroll through social media, it's just the same three or four names. NVIDIA, AMD, Microsoft.
Always.
It's all about the chips, the LLMs, the software wizardry.
Yeah, that's the glamour layer of the industry, right? Everyone loves the rock stars. It's where all the hype is.
Exactly. But I was looking through this stack of research you sent over, and it got me thinking about the physical reality of all this. We talk about the cloud like it's this ethereal thing.
Right, like it's just floating up there.
But it's not. It's heavy. It's incredibly hot. It consumes a massive amount of power. And someone, somewhere, actually has to bolt the thing together.
And that is the multi-billion-dollar question that gets ignored way too often. Because, look, you can have the fastest H100 chip from NVIDIA, but if you don't have a motherboard that can handle it or a cooling system that stops it from melting...
It's just a very expensive paperweight.
An incredibly expensive paperweight, yeah.
And that brings us to the subject of today's analysis. We are looking at Sanmina Corporation, ticker symbol SANM.
I like to call them the steel skeleton of the AI boom.
And usually Sanmina is, well, let's be honest, in the past they've been seen as a bit of a legacy player. Reliable, steady.
Maybe a little boring.
A little boring, yeah. But looking at the reports from late 2025, specifically this pivot point coming into 2026, they're not looking so boring anymore.
No, boring is out the window. 2025 was a massive identity upgrade for them. They've effectively graduated from being a background component maker to being a central figure in the whole computing grid.
Moving up the food chain.
Big time.
So here's our mission for this conversation. We've got a comprehensive set of reports on Sanmina, and we need to break down three specific areas. First, the investment thesis. Why is this company interesting right now?
Yep.
Second, the valuation, because the stock's been moving, and we need to know what the numbers are telling us. And third, the risks, because a pivot like this is never without danger.
It's a classic risk-reward setup, but on a scale we really haven't seen from this company before.
Let's start with that identity upgrade you mentioned. We can't talk about Sanmina in 2026 without talking about the catalyst.
The ZT Systems acquisition has to be the starting point.
Right. This closed late in 2025. This was the manufacturing business they bought from AMD.
Correct. And to understand why this matters so much, you have to look at the industry chessboard. AMD bought ZT Systems, but AMD is a chip designer. They don't want to run factories. That's low-margin, heavy lifting work.
It's messy.
It is messy. So they kept the brains, the design teams, and they sold the muscle, the manufacturing arm, to Sanmina.
For about $3 billion, right?
Roughly, yeah. $3 billion in cash and equity. But look at what Sanmina got for that. Before this deal, Sanmina was what we'd call a Tier 2 supplier.
Yeah.
They'd make you a very nice circuit board, maybe some cables, a metal enclosure, but they were shipping those parts to the people who built the servers.
They were just an ingredient in the recipe.
Exactly, an ingredient. And now they are the guy building the server. With ZT Systems, they became a general contractor for the hyperscalers. We're talking Amazon, Microsoft, Google.
So they're not just sending a box of parts anymore. They're rolling fully assembled AI racks out the door.
That's it. It's a massive jump in responsibility. You go from making the bricks to building the entire cathedral.
And I imagine a massive jump in revenue.
Oh, yeah. This acquisition adds an estimated $5 to $6 billion in annual run rate revenue.
That's huge.
Yeah.
I mean, looking at their historical numbers, that's not just growth, that's a step change.
It is. Their goal is to double total revenue to around $16 billion within 3 years. That's incredibly aggressive for a manufacturing company.
And we're already seeing the immediate impact. I was looking at their guidance for Q1 of fiscal 2026, which ends December 2025. They're projecting revenue to jump 52%.
It's just in one quarter. Yeah, the guidance is between 2.9 and 3.2 billion. That's the ZT effect kicking in right away.
Okay, so they bought the revenue, they bought the capability. Let's dig into the investment thesis. Because getting bigger is one thing, but getting better is another. Why does this make them a buy now?
It really comes down to 3 pillars. The first one is what we call the moat, or more specifically, vertical integration.
Vertical integration. That's one of those MBA buzzwords that gets thrown around. What does it actually mean on the factory floor for Sanmina? Why should you care?
Well, in the EMS space electronic manufacturing services, it's actually pretty rare to be truly vertically integrated. Most competitors are basically assembly lines. They buy a fan from vendor A, a case from vendor B, a board from vendor C.
They just screw it all together.
They're logistics companies, really, organizing other people's work. Sanmina makes the stuff. That is the core difference. They produce the high-complexity PCBs, they make the cables, they fabricate the metal enclosures, they even do memory packaging.
So they're their own supplier.
And here's the number from the research that just blew my mind. In a single AI server rack, Sanmina can capture over 80% of the manufacturing value add internally.
80%.
Yeah.
That seems incredibly high.
It's unheard of. But think what that means for a customer like Microsoft. If you're rushing to build a data center to train the next GPT, speed is everything. It's the only currency that matters.
Right.
If your cable supplier in Taiwan says, wait 6 weeks for the boat, you're dead in the water. Sanmina says, okay, we'll spin up the line in our cable plant and have it next week.
That control over the supply chain speed
Yeah.
in the AI race, that's not just a convenience. That is a strategic weapon.
It absolutely is.
Yeah.
And it also helped with margins. But that leads us right to pillar 2 of the thesis. Their leadership in AI and liquid cooling.
This is the hot topic.
Literally.
Unintended. These new chips, the Blackwells and whatever is next, they run so incredibly hot.
They do. And this is a technical point I think people miss. We're hitting the physical limits of air cooling. You just can't blow fans at these racks anymore. The physics doesn't work. You need liquid.
Piping coolant directly to the chip, which sounds terrifying for electronics.
It is terrifying. A leak in a data center is a catastrophe. It shorts out millions of dollars of equipment in an instant. So the manufacturing precision you need has just skyrocketed.
And the ZT deal helps with that.
The ZT deal brought in huge expertise in rack-scale cooling, but Sanmina also has this sort of secret weapon called the 42Q system.
I saw that in the notes. It's a cloud-based manufacturing software.
It's more than that. Think of it as the nervous system for their whole operation. It connects something like 35,000 machines across all their global factories. It gives them real-time control.
So if a machine in Mexico is drifting out of calibration by a millimeter, they know instantly.
Instantly. They catch the error before the part is even made. And when you're building liquid cooling systems where a hairline fracture means a catastrophic leak, that precision is everything.
Okay, that sounds impressive. But I have to play devil's advocate. We've seen tech cycles boom and bust. Is Sanmina just an AI play now? If the hyperscalers tap the brakes on spending, do they drive off a cliff?
That is a great question, and it brings us to pillar 3, the boring cash cows.
I do love a boring cash cow.
You should. It's the ballast in the ship. See, Sanmina isn't only AI. They have these deep, multi-decade roots in industrial, medical, defense, and automotive.
I remember reading about them making MRI machines.
MRI machines, surgical robots, defense communications. Think about those products. You don't replace an MRI every 6 months like a phone. The product life cycles are 5-10 years long. The regulatory barriers are huge.
You can't just start making FDA-approved medical devices in your garage.
No, so it's incredibly sticky revenue. It provides stable, predictable cash flow. So while the AI side gives you that explosive growth and the volatility that comes with it, the medical and defense sides keep the lights on. It de-risks the whole portfolio.
Speaking of de-risking, what about geography? We hear so much about China risk.
They're very well positioned there. They have a massive footprint in Mexico, Guadalajara, and in the U.S., Texas, and California. Compared to competitors who are still really China-centric, Sanmina looks much safer to, say, a U.S. defense contractor.
Okay, so we've got the transformation, we have the thesis. Let's get into the weeds on valuation. Because a good company isn't always a good stock. Where does Sanmina stand today?
Well, as of mid-January 2026, the stock has been on a tear. It recently hit a 52-week high, trading around 177 to 178.
Which puts the market cap just under $10 billion.
Right, around 9.5 to 9.7 billion.
And that feels like a key moment. It's not a small cap anymore. What are the analysts saying? Is there a consensus?
Not at all. It's a battleground. You have the skeptics who have price targets around 120. They're looking at the chart and saying it's gone too far too fast. They're worried about integration risks.
And the bulls?
The bulls are raising targets to the $190, even $200 range. But the real story here, the core of their argument, is something called multiple expansion.
Okay, let's unpack that for someone who might not be a finance pro.
Sure. So historically, EMS companies, the manufacturers, they trade at low valuations, a low price to earnings, or PE ratio. Maybe 14 times earnings. It's seen as a low-margin, grinding business.
So investors will pay you $14 for every dollar of profit you make.
Exactly. Which is low compared to a tech company where you might pay 30 or 40. But the argument is that Sanmina is graduating. If the market stops seeing them as a dirty factory and starts seeing them as a critical AI infrastructure partner, that multiple expands. It could go to 18, maybe even 22 times earnings.
So the stock price goes up even if the earnings stay flat just because the perception of the company changes.
Correct. But here's the thing. Earnings aren't staying flat. They're growing. The estimates for 2026 have moved up to around $11.46 per share. So do the math. You apply a 20 times multiple.
You're well over $220 a share.
Exactly. That's the bullish case. You get the double whammy, earnings growth, and a higher valuation multiple. We're seeing similar re-ratings with peers like Celestica and Jabil. The market's waking up.
Okay, that sounds great if you own the stock. But my job is to worry. We have to look at the other side. What could derail this? Let's talk risks.
And there are real risks. The biggest one, looming over everything, is integration risk.
Buying a business is easy. Merging it is hard.
It is, especially when that business ZT Systems is adding such a massive chunk of revenue. They're merging cultures, logistics, IT platforms. If they stumble, if they miss a shipment, if quality drops, the market will punish them severely.
They have a reputation for efficiency, but this is a whole different scale.
It is. And then you have customer concentration risk. I call it the AI whale problem.
Because there are only a handful of companies buying these things.
Right. You've got Microsoft, Amazon, Google, Meta, maybe one or two others. If just one of those whales decides to cut their capital spending, their CapEx Sanmina takes a direct hit.
It's not like selling iPhones to millions of people. You have 5 customers.
Exactly. If Google catches a cold, Sanmina gets pneumonia. They are relying on a very small club of very large customers.
That's a precarious position. If AI hype cools even a little, those orders could dry up fast.
And connected to that is margin pressure. This is a subtle one. We talked about revenue soaring, but profit margins are a different story.
How so?
AI servers are expensive. They drive huge revenue numbers. But the actual profit percentage on each one can be lower than, say, on a specialized medical device. It's the empty calories, risk lots of revenue, but is it nutritious profit?
So they could be doing twice the work for the same actual profit dollars if they aren't careful.
That's the risk. And finally, you just have the macro factors. Supply chain disruptions, tariffs. Even though they're in Mexico and the US, the components, the chips, the raw materials, they still cross borders.
Right, a chip might go from Taiwan to Malaysia to Mexico to Texas.
And any geopolitical tension is basically sand in the gears of that machine. It hurts their speed advantage, which is their main value prop.
So pulling it all together, we have a company that has, fundamentally changed its identity, moving from the background to the foreground of the AI revolution.
That's the best way to put it. Sanmina is no longer a spectator. They're building the stadium. They've got that steel skeleton role.
But for you listening and trying to decide what to do with this, is there a specific event we should be watching? Because talk is cheap.
Absolutely. You need to mark your calendar, January 26, 2026.
That's the Q1 fiscal 2026 earnings call.
Yes, this call is critical. It will be the first real proof of the ZT Systems integration.
The moment of truth.
We'll see if that 52% revenue jump actually happened. We'll see how the margins held up, and we will hear the guidance for the rest of the year.
Until then, it's all projections. That call gives us the first look at reality.
It really seems like the big question isn't just about demand. We know everyone wants AI servers. It's about execution. Can Sanmina execute the logistics of this new, massive operation perfectly?
If they can, that re-rating we talked about creates a lot of potential upside.
And if they stumble, that valuation could contract just as fast as it expanded.
It's a fascinating setup. You've got the boring stability of medical devices underwriting this massive high-stakes bet on the future of AI. It's not a pure-play hype stock, but it's definitely not your grandfather's manufacturing company anymore.
It isn't. And that's what makes the market so interesting. Sanmina found a way to reinvent itself 40 years into the game.
It's definitely one to keep on the radar. It's gone from a background player to a central figure in this whole data center build-out. We'll leave it there for today. Continue to watch for our next release.